Good morning. Today we are going to discuss about a new topic which is one of the very interesting, current and very favorite topic, that is money, banking and central banking. In this chapter we are going to learn 5 important aspects of the chapter. We have 5 learning objectives. First, we'll define the functions of money, identify the key properties that money possesses, and explain the official definitions of money supply. Second, understand why the financial intermediaries such as banks exist. Third, describe the basic structure and function of the Federal Reserve System. Fourth, determine the maximum potential extent that money supply will change following a Federal Reserve monetary policy action. Fifth, explain the essential features of the Federal Deposit Insurance. Our third learning objective is to understand the basic structure and functions of the Federal Reserve System. Fundamentally, Federal Reserve System serves as the nation's central bank, and it is one of the key banking institutions in the United States. It is partly a creature of the government and partly privately owned. It is one of the most important regulatory agency in the United States monetary system. It was established in 1913 by the Federal Reserve Act and was signed by President Woodrow Wilson. Here, please pay your attention to the organization of the Federal Reserve System. It is managed by the Board of Governors, which is composed of 7 full-time members appointed by the US President with the approval of Senate. The chair of the Board of Governors is leading official of the Board of Governors. The chairperson is Jerome Powell. The 12 Federal Reserve District banks have 25 branches. The boundaries of the 12 Federal Reserve districts and the cities which are the Federal Reserve banks are located, and that can be shown in the next slide. The Federal Open Market operations, or the committee, determines the future growth of the money supply and other important variables. This committee is composed of members of the Board of Governors, the President of New York Federal Reserve Bank, and the President of 4 Federal Reserve banks, rotated periodically. The Chair of Board of Governors also chairs the Federal FOMC, that is your Federal Open Market Committee. In this slide, you can see the organization of the Federal Reserve System and various functions. The Board of Governors, they set reserve requirements and approves the discount rates as the part of monetary policy. You can mention what is reserve requirement and discount rate in the discussion board. They supervise and regulate member banks and bank holding companies. They establish and administer protective regulations in consumer finance. They oversee the Federal Reserve banks. The Board of Governors, they exercise general supervision on the Federal Reserve banks. The Federal Reserve banks propose discount rates, hold reserve banks for depository institutions, and lend them at the discount window. They furnish currency, collect and clear checks, and transfer funds for depository institutions. They handle the US government debt and cash balances. There are also Consumer Advisory Council, Federal Advisory Council, Thrift Institution Advisory Council, who advise the Board of Governors. The Board of Governors and the Federal Reserve Banks, they form the Federal Open Market Committee. They direct the open market operations, that is, buying and selling of existing US government securities, the primary instruments of monetary policy. This is the latest information that I could get. We have 8,000 commercial banks, 1,500 saving and loan association and saving banks, and nearly 12,000 credit unions. This figure shows the Federal Reserve System is divided into 12 districts, each served by one of the Federal Reserve District banks, which is located in the cities which are indicated over here. The Board of Governors meets in Washington, D.C. The first function is that the Fed supplies the economy with fiduciary currency. The Federal Reserve Bank supplies the economy with paper currency, which is called as the Federal Reserve Notes. Even though all the Federal Reserve Notes are printed by the Bureau of Engraving and Printing in Washington, D.C., each note is assigned a code indicating which of the 12 Federal Reserve banks first introduced the note into circulation. Moreover, each of these notes is an obligation, a liability of the Federal Reserve System, not the US Treasury. The Fed holds the depository institutions' reserves and provide payment clearing system. The 12 Federal Reserve District banks hold the reserves other than the vault cash of the depository institutions. Depository institutions are required by law to keep a certain percentage of their transaction deposits as reserves. Even if they were not required to do so by the law, they would still wish to keep some reserves on which they can draw funds as needed for expected and unexpected transactions. The Federal Reserve System also operates for transmitting and clearing payments among the depository institution reserve accounts. The Federal Reserve banks all offer check clearing services and electronic payment transfer services to the commercial banks, saving institutions, and the credit unions. The Fed acts as the government's fiscal agent. The Federal Reserve is the primary banker and the fiscal agent for the federal government. Consequently, the US Treasury has a transaction account with the Federal Reserve, which helps the government to collect certain tax revenues and aids in the purchase and sale of securities. The Fed supervises the depository institutions. The Fed, along with the controller of the currency, the Federal Deposit Insurance Corporations, and the Office of the Thrift Supervision of the Treasury Department, and the National Credit Union Administration is a supervisor and the regulator of the depository institution. The Fed conducts monetary policy, and it is one of the most important tasks of Fed because they want to regulate the nation's money supply. So here what we have to do, we have to examine more closely its reserve holding function and the manner in which the depository institutions they aid in the expansion and contraction of money supply. It means whether there will be increase in the money supply in the economy or decrease in the money supply in the economy. The Fed intervenes in the foreign currency market. Sometimes the Fed attempts to keep the value of dollar from changing. So this can be done by buying and selling of US dollars in the foreign exchange market. So more about this topic will be discussed in other chapters. Last but not least, the Fed acts as the lender of last resort. From time to time, an individual bank that is otherwise in the good financial condition may be temporarily low on the cash and other liquid assets. Such an institution is said to be illiquid. A key justification for the formation of the Federal Reserve System was that the Fed would stand ready to prevent temporarily illiquid banks from failing by serving the financial system's lender of last resort. So in this capacity, the Fed stands ready to lend any temporary illiquid but otherwise financially healthy banking institutions. The Fed seeks to prevent illiquidity at a few banks from leading to a general loss of depositors' confidence in the overall soundness of the banking system. Because if there will be loss of confidence among the depositors, there is a high chance of a banking crisis. When many banks, non-bank financial institutions and other companies struggled with serious financial difficulties in 2000, Fed provided billions of dollars as a lender of last resort assistance to these companies for the bailout purpose. Thank you for your kind attention. If you have any questions relating to this topic, feel free to ask your questions on the Google Doc that I have shared with you. You can post your questions on the discussion board as well. I am also available via Zoom to answer any of your queries, any of your questions relating to this chapter. Thank you.